Welcome back to Boni's Life, the channel where we dissect the crypto markets with surgical precision and deliver insights that the mainstream media simply cannot match. Today, we're diving headfirst into a sea of red, and I want you to pay very close attention because what I'm about to share with you could save your portfolio or help you capitalize on one of the most significant market events we've seen in months. The past 24 hours have been nothing short of a bloodbath, a brutal reckoning for over-leveraged bulls, and a stark reminder that in the world of digital assets, fortunes can be made and lost in the blink of an eye. We're going to unpack the carnage piece by piece and give you the intel you need to navigate these treacherous waters with confidence and clarity. In this episode, we'll be covering the massive liquidation cascade that wiped out over $800 million in leveraged positions, the Federal Reserve's latest move, and what it really means for your portfolio, the global macroeconomic forces at play, including the stunning rally in gold and the weakness in tech stocks, and a deep dive into their on-chain data to reveal what the smart money is doing right now. And as always, we'll cap it off with actionable trading scenarios and key technical triggers to watch for in the next 24 hours. So buckle up, because this is the most important crypto market analysis you'll see all week. If you're new to the channel, make sure to subscribe and hit that notification bell because you don't want to miss what's coming next. Let's start with the big picture. The global crypto market cap has plummeted to $2.95 trillion, representing a staggering 5.2% drop in just 24 hours. To put that in perspective, we've seen approximately $160 billion in value evaporate from the crypto ecosystem in a single day. Bitcoin, the king of crypto and the bellwether for the entire market, has taken a heavy blow, dropping 5.4% to trade at $84,423 as of this recording. This represents a significant pullback from the recent highs we saw earlier this month, and it's testing critical support levels that we'll discuss in detail later in this analysis. Ethereum is faring even worse than Bitcoin, down a painful 6.5% to $2,801. This underperformance relative to Bitcoin is significant because it tells us something important about market sentiment. When Ethereum underperforms Bitcoin during a sell-off, it typically indicates that risk appetite is contracting rapidly and investors are rotating out of higher beta assets into the relative safety of Bitcoin. The altcoin market is a sea of red across the board, with Solana down 6.9%, XRP down 5.1%, and Dogecoin, the poster child of meme coins, down a whopping 7.0%. The only outlier showing any resilience is Tron, which is barely hanging on with a mere 0.2% dip. The 24-hour trading volume is a massive $136 billion, which is significantly elevated compared to recent averages and is a clear sign of heavy selling pressure and capitulation across the market. Now, let's peel back the layers and look at the derivatives market, because this is where the real story unfolds and where we can gain crucial insights into market positioning and sentiment. The past 24 hours have witnessed a catastrophic liquidation event that ranks among the largest we've seen this year. A mind-boggling $801.92 million in leveraged positions have been wiped out, representing a 150% increase from the previous day's liquidation volume. And here's the kicker that really tells the story. A staggering 86.5% of those liquidations were long positions. This was a classic long squeeze, a brutal flush out of over-leveraged bulls who were betting on a continued rally and got caught on the wrong side of a violent move. The largest single liquidation was a massive $31.64 million position on Hyperliquid, a clear indication that even institutional-sized players and sophisticated traders were caught in the crossfire. This wasn't just retail getting wrecked. This was a market-wide event that affected traders at all levels. The Fear and Greed Index has plunged to 25, firmly in fear territory, down from the greed readings we saw just a week ago. The RSI is hovering at a weak 33.93, signaling oversold conditions that could either lead to a bounce or, if breached, to open the door for even more downside. The long/short ratio is now skewed towards shorts, with 51.82% of traders betting on further downside. This is a market gripped by fear, a market that has just experienced a significant deleveraging event. Let me break down the liquidation data by exchange for you because the details are illuminating. Hyperliquid led the carnage with $138.31 million in liquidations, followed by Bybit at $110.21 million, Binance at $78.22 million, Bitget at $55.85 million, and Gate at $55.18 million. Across all these exchanges, the pattern is remarkably consistent. Over 90% of liquidations were long positions. This tells us that the market was heavily positioned for upside, with traders leveraged to the hilt expecting continuation of the rally we saw earlier this month. When the rug was pulled, the cascade was devastating and self-reinforcing. Over 212,578 traders were liquidated in the past 24 hours. That's over 200,000 people who saw their positions forcibly closed, their capital wiped out. This is a sobering reminder of the risks of leverage in the crypto market and why risk management should always be your top priority. So, what triggered this massive sell-off? The answer lies in Washington, D.C., where all eyes were on the Federal Reserve's FOMC meeting yesterday. As expected, the Fed held interest rates steady at 3.5% to 3.75%, pausing after 3 consecutive quarter-point cuts that brought rates down from their peak. But as any experienced trader knows, the devil is always in the details, and the details of this meeting were decidedly hawkish. The decision was not unanimous, with 2 dissenting governors, both Trump appointees, voting for another rate cut. This signals a growing divide within the Fed and introduces uncertainty about the future path of monetary policy. More importantly, the Fed's statement struck a hawkish tone that caught many market participants off guard. They acknowledged that economic activity has been expanding at a solid pace and that inflation remains somewhat elevated. They also removed language that suggested a higher risk from a weakening labor market, indicating that their focus is shifting back to taming inflation rather than supporting employment. In his press conference, Fed Chair Jerome Powell reinforced this sentiment, stating that the economic forecast is stronger and that inflation is performing as expected. He emphasized that the Fed is in no rush to cut rates further and will remain data-dependent, which is Fed speak for don't expect any rate cuts anytime soon. What does this mean for crypto? A hawkish Fed is unequivocally bearish for risk assets like cryptocurrencies. The prospect of higher for longer interest rates reduces liquidity in the market, increases the opportunity cost of holding non-yielding assets like Bitcoin, and makes safer assets like bonds more attractive on a risk-adjusted basis. The market is now pricing in the next rate cut for June 2026 at the earliest, a significant shift from previous expectations that had priced in cuts as early as March. The US dollar index has strengthened on the back of this news, which is another headwind for crypto since Bitcoin and the dollar typically have an inverse correlation. And let's not forget the political drama unfolding in the background. Powell has been subpoenaed by the Justice Department and the Supreme Court is hearing a case on the Fed's independence. This uncertainty adds another layer of risk to the market and could lead to increased volatility in the weeks ahead. Beyond the Fed, other global macro forces are at play that every crypto trader needs to understand. We're seeing a classic risk-off rotation in the markets, the kind of broad-based de-risking that typically occurs when investors become concerned about economic growth or geopolitical stability. Gold has surged to a record high of over $5,600 an ounce before pulling back to around $5,200, a clear sign that investors are fleeing to safety and seeking protection against uncertainty. Silver has also extended its gains to $117 an ounce, confirming the precious metals bid. But here's the interesting and somewhat troubling part for Bitcoin bulls. Bitcoin is not behaving like a safe haven asset. It's trading like a high beta risk asset, highly sensitive to liquidity conditions and correlated with equities rather than gold. As JP Morgan noted in their recent research report, gold and hard assets are rallying on dollar weakness, but Bitcoin is lagging. This is a crucial distinction that every investor needs to understand. In the current environment, Bitcoin is not digital gold. It's a risk-on asset that is getting hammered alongside other speculative investments. The Nasdaq is down 1.5%, and big tech stocks like Microsoft are getting hit hard after their earnings reports disappointed on cloud growth metrics. This correlation with the broader stock market is another bearish signal for crypto and suggests that we may see continued pressure if equities continue to sell off. Now, let's get technical because understanding the key levels is essential for making informed trading decisions. Bitcoin is currently trading below a key bull-bear threshold, the short-term holder cost basis, which stands at $96,500. This metric represents the average acquisition price of coins held by short-term holders, and historically, trading below this level has been associated with bearish market conditions and increased selling pressure. The fact that we're trading significantly below it is a bearish sign that should not be ignored. The current market structure is eerily similar to what we saw in Q1 2022 and Q2 2018, both of which were followed by deeper corrections that tested investor resolve. The next critical support level to watch is the lower support band at $83,400. This level represents a confluence of technical factors including horizontal support, the 200-day moving average, and the lower Bollinger Band. A break below this level could open the floodgates for a deeper correction towards the true market mean at $80,700 and potentially even lower to the $75,000 to $78,000 range, where we find significant historical support. On the upside, the 50-day moving average at around $89,000 is now acting as a key resistance level. We need to reclaim this level with conviction to see any semblance of a bullish reversal. Let's look at what the on-chain data is telling us, because this is where we can gain insights that aren't visible in price action alone. Glassnode's analysis reveals that while there's stress building below resistance, widespread capitulation has not yet materialized. 19.5% of short-term holder supply is currently at a loss, which is elevated but still below the 55% threshold that typically signals a market bottom and the kind of capitulation that creates generational buying opportunities. However, downside sensitivity persists, and the market remains vulnerable to further selling pressure. The market is leaning on the conviction of spot holders rather than fresh demand from ETFs. In fact, US spot Bitcoin ETF flows have been neutral to slightly negative over the past week, indicating that institutional demand remains cautious and that the smart money is not rushing to buy this dip. The perpetual futures market has been flushed out, with leverage at a minimum and funding rates near zero. This is actually a constructive development because it means that the market is now reliant on spot-driven demand for any kind of recovery, which tends to be more sustainable than leverage-driven rallies. The spot CVD, or cumulative volume delta, is showing some interesting signals that warrant attention. Binance is leading a rebound from deep negative territory, suggesting that marginal buy pressure is returning on the world's largest exchange. However, Coinbase remains range-bound, indicating that US-led spot demand has been steadier but less aggressive than offshore flows. This divergence points to a market where the marginal bid strength is returning, but it's being driven more by global risk appetite than a decisive US spot impulse. If this buy-side dominance persists, it could support further price stabilization, but the market has repeatedly struggled to sustain positive CVD trends through this cycle, so follow-through will be key. So, what's next? Here are 3 potential scenarios for the next 24 hours, each with assigned probabilities based on my analysis of the technical and fundamental factors we've discussed. Scenario 1, bearish continuation. I'm assigning this a 55% probability, making it the most likely outcome based on current conditions. In this scenario, the price of Bitcoin continues to bleed lower, testing the critical support zone of $83,400 to $84,000. The risk-off sentiment persists as traders digest the hawkish Fed messaging, and gold continues to rally as investors seek safety. The target for this scenario is a drop to the $83,000 to $84,000 range, with potential extension to $80,700 if support fails. The key trigger for this scenario is a break below the $86,100 support level on high volume, which would confirm bearish momentum and likely trigger another wave of liquidations. Scenario 2, consolidation. I'm assigning this a 30% probability. In this scenario, the price stabilizes in the $85,000 to $88,000 range as the market takes a breather following the violent move. Volatility subsides as traders await the next catalyst, and we see a period of range-bound trading that allows the market to digest recent losses. The target for this scenario is a sideways grind in the $86,000 to $87,000 range. The key trigger for this scenario is a decrease in trading volume, stabilization of funding rates near zero, and a lack of follow-through selling below current levels. Scenario 3, relief rally. I'm assigning this a 15% probability, making it the least likely but still possible outcome. In this scenario, we see a short squeeze that triggers a bounce as over-leveraged shorts get caught offside. Bitcoin reclaims the $88,000 to $89,000 resistance level and potentially tests the $90,000 psychological level. This would require a positive catalyst, such as a sudden dovish shift from the Fed, a major positive news event in the crypto space, or a reversal in risk sentiment across broader markets. The target for this scenario is a rally to the $89,000 to $90,000 range. The key trigger is a reclaim of the $88,000 level with strong volume and a flip in funding rates to positive. For those of you looking to trade these scenarios, here are my recommendations based on risk-adjusted returns and probability-weighted outcomes. For scenario 1, consider short positions with a stop loss above $88,500 and a target of $83,500. Position size conservatively given the elevated volatility. For scenario 2, stay on the sidelines and wait for a clearer directional move. Use this time to accumulate dry powder for when the market provides a higher conviction setup. For scenario 3, consider long positions only after a confirmed break above $88,000 with a stop loss below $86,000. This is a lower probability scenario, so position size should reflect that. Now let me share some key technical triggers to watch in the next 24 hours that will help you navigate this market with confidence. First, watch the $86,100 level closely. A break below this level on high volume would confirm the bearish continuation scenario and open the door for a test of $83,400. Second, watch the $88,000 to $89,000 resistance zone. A reclaim of this zone with strong volume would be the first sign of a potential relief rally and could trigger short covering. Third, watch the funding rates across major exchanges. A flip to significantly positive funding rates would indicate that bullish sentiment is returning and that traders are willing to pay a premium to go long. Fourth, watch the Bitcoin dominance metric. If Bitcoin dominance continues to rise, it could signal that altcoins are in for even more pain as capital rotates to the relative safety of Bitcoin. Finally, watch the gold price and the DXY dollar index. If gold continues to rally and the dollar strengthens, it's a sign that risk-off sentiment is still dominant, which is bearish for crypto. So, there you have it, a comprehensive breakdown of the current crypto market turmoil that goes deeper than anything you'll find on mainstream financial media. The key takeaways are this: the market has just experienced a massive deleveraging event with over $800 million in liquidations. The Fed's hawkish stance is a major headwind that will persist for the foreseeable future, and Bitcoin is trading like a risk asset rather than a safe haven. The on-chain data suggests that while we're not in full-blown capitulation mode yet, the market is fragile and vulnerable to further downside. The key technical levels to watch are the $83,400 support and the $89,000 resistance. A break off either of these levels will likely determine the market's direction in the short term. This is a time for caution, a time for disciplined risk management, and a time to think clearly while others are panicking. Don't get caught in the chop. Wait for confirmation, wait for the market to show its hand, and always have a plan before you enter a trade. Remember, in markets like this, capital preservation is just as important as capital appreciation. The opportunities will come, but only for those who are patient and prepared. Thank you for joining me on Boni's Life. If you found this analysis valuable, be sure to like, subscribe, and hit that notification bell so you don't miss our next deep dive. And let me know in the comments below what you think is next for the crypto market. Are we headed for more pain, or is a relief rally on the horizon? I want to hear your thoughts and engage with this community. Until next time, trade smart, stay disciplined, and stay safe.